And let me get to the screen share.
And I will be monitoring questions in the chat box.
Okay, perfect. Fantastic. It's so fancy, you know, PowerPoint. If it works the whole time, I'll be delighted. All righty. So thank you so much for
hope for the best.
Yes, between the Russian and the Italian, we wish you luck. Oh boy. Ready to get started, or did you need, I don't know if your group is.
Oh, we're ready. Nope.
You're ready. Okay, perfect. All righty. Well, good morning, everyone. I'm Joanne Koontz. I'm an attorney and CPA, and I'm here with my partner, Marina Parkin, who is a CPA and extraordinaire when it comes to all things taxes for real estate agents. I speak on this topic frequently. There are usually lots of questions, so feel free to interrupt us as we go. The big thing I will say is it's important that no matter who you're working with in terms of lawyers and CPAs, that you understand and appreciate that what you do is so unique. So you may be getting great legal advice, you may be getting great tax advice. If that provider doesn't understand the nuances of the Florida Real Estate Commission rules, you might still be missing out or be violating something inadvertently. So just make sure that whoever you're working with, that you've got, that person has a handle on the FREC rules, because you are looking at complying with IRS rules, with Florida state corporate law rules and FREC, and that they don't care about each other. So there's no overlap there. In fact, there's a lot of times where the rules bang into each other and you're still supposed to follow all of them. So without further ado, let's get started. For many realtors, particularly when they first get started, they're operating their business. I'm Joanne Koontz, realtor. All of my income is reported on Schedule C of my personal tax return, which is two things: cheap, fast, but not the best tax strategy. So oftentimes when people are getting into this business, or people that have been in the business for a long time, who started small and then got busier, say, I never thought to need a business structure or to do anything with this. So some reasons to consider forming a business for your real estate practice are tax benefits, which are substantial, and I'll let Marina talk a little bit about that in just a second. Of course, I'm a lawyer, so I like liability protection. If anybody is familiar with Morgan & Morgan, they're for the other people. They are not for you. So you will have a run-in at some point. And if you do, you want to have your assets protected. Also, future goals and plans for the business. So, as advisors, we are simply not trying to just keep people in compliance. We're trying to help businesses grow and prosper. And if you are getting into business, the first thing we want to talk about is how do you get out? So from an exit planning strategy, and how do you grow this business, possibly scale it, work it up to something that you could sell when you are done. You've got to have a structure. Nobody wants to buy your practice when it's just your name. Of course, from an accounting standpoint, and insurance. We can't insure your exposures to liability without a business structure, and we'll talk more about that in just a second. So if you're going to have a business, you really only have two choices. You can be an LLC or a corporation. As a realtor, because you are required to have a license, we always recommend that you form a PLLC, which stands for Professional Limited Liability Company. My firms, Koontz and Associates PL, Koontz and Parkin PLLC, we are operating under that same structure. It's telling the world that you have to have a license to do the job. So you'll often see architects, engineers, lawyers, accountants using this designation, and it is available for you as well. If you look at some of the more seasoned agents and folks that have been in the business for some time, they're operating under what's called a PA. A PA is the equivalent to the PLLC, but where you formed a corporation. So it's a corporation where you have to have a license to do the job, and PA stands for Professional Association. There's very little difference between the LLC and the corporation. So if you've already got a PA, I would not suggest that you change and move to a PLLC. Just stay where you are. There are some differences, but the liability protection that's available from each of those entity structures is identical, provided that you follow the rules. What are the rules? Well, you'll see that the seasoned folks have a PA because the LLC never used to be available to realtors. FREC had said, if you want to be any kind of entity, you've got to be a PA. They wouldn't allow an LLC. I would say it's getting on to be about 10 years now that they've had that changed and opened up so that agents can use the PLLC. Like I said, I wouldn't change it. But lots of people who have done this themselves have formed it and just done LLC instead of PLLC. You don't have a lot of choice here when you set this up. You've got to use your legal name. So if you're Joseph, you can't have Joe in the name. I would have to be Joanne Koontz, PLLC, or Joanne Koontz, PA. If you've done LLC, I would change it to PLLC, but FREC will issue you a license with just the LLC. You are allowed to have that. What are the requirements? They're essentially the same, except that with the PA, you're required to hold an annual meeting and keep minutes. And oftentimes people get stuck in this very dangerous trap where they say, how am I supposed to hold a meeting with myself? That seems dumb. It's just me. You have to be very careful about saying it's just me about anything here, because it's just me is exactly the argument that Morgan & Morgan wants to make. Morgan & Morgan wants the court to disregard and look past your entity and say, there's no difference between Joanne Koontz and Joanne Koontz PA, so let's go after her personal assets to satisfy this judgment. If you have a corporation, if you have a PA, you are required to hold an annual meeting and keep minutes. They don't have to be fancy, they don't have to be recorded anywhere, but you do have to have them in your corporate records. On the PLLC side, that is not required. It's a good idea, it's best practices, but it's not required. You're not having any kind of chink in your armor of protection if you fail to have those. So if people are starting out of the gate, as much paperwork as agents encounter, they're not really good at your own paperwork. So I always encourage my agents to use the PLLC, but if you're RPA, I would not switch. In both entities, you're required to file an annual report with SunBiz. That's $138, and it's due by May 1st every year. You need a separate tax ID number. We need a separate bank account. We actually have to use that bank account. Deposit your commission checks in that bank account. Do not commingle your funds. That means don't pay your business expenses with your personal checking account, and don't pay your personal expenses with your business account. And finally, on both sides, you get the benefit of the choice of taxation. Now, that sounds like a big bag of fun. When you get to choose your tax, then you get all kinds of benefits. So I'll turn that over and let Marina touch on that.
Absolutely. Actually, before we get into it, Joanne, I see a lot of folks come my way who have done their own formation or had a previous attorney or CPA do formation for them, and they come with all sorts of companies in their backpack. So they've got an LLC, they've got Inc., they have partnerships. They are sometimes coming from a different state with these entities. What would you recommend in this case? You mentioned that if they're already a PA, there is really no reason for them to switch to a PLLC. If they just went ahead and formed an LLC, but they may have used a different name, maybe they said, the Best Realtor LLC, what should they do in this case?
So if you've already formed something and the name is not permissible, FREC will not allow you to get a license with anything other than your legal name. Your choices are first name, middle initial, last name, first name, middle name, last name. That's as creative as you can get. So what I try to do when that happens is I talk to people about what their long-term plan is. Are they planning to do a team, or are they planning to stay by themselves? If they're planning to do a team, I will probably take that wrong LLC and flip that into the team and form brand new PLLCs from the start. If they don't plan to have a team, we can do a name change and fix that wrong LLC. That is just almost the same amount of time, maybe a little bit more, as us doing everything from scratch, because now we've got to go back and communicate with IRS and possibly FREC. A lot of times if people have done it on their own, they haven't gotten all the way to FREC, so they've formed and they think they have an LLC, but it's not properly done, so they're not going to get the tax benefit anyway. But I would look at that on a case-by-case basis and determine what the best way is, the most economic way is to salvage that so that they can continue to use it, but flip it into something that is conforming with the FREC rules. And I'll talk about teams in just a little bit.
Yes, I cannot stress enough when we see people come on the tax side and they have an entity, even if it's, you know, it was formed properly, the name is correct, the EIN number exists, but FREC was never notified and the brokerage was never notified. So what happens is the 1099 that the brokerage issues is still under the individual realtor's name. So they show up with formation documents in one hand and their 1099 issued to their personal name in another. And, you know, Joanne and I always equate it to, you know, you build a garage and then you put your Ferrari right outside. So comes the storm and the tree falls right on your Ferrari and you're going to say, well, I have the garage. Sure, but you didn't park your car in it.
Yeah.
So once you get the 1099 issued by the brokerage under your personal name, IRS has a copy of that. So they're expecting you to see that on your personal return, not on your entity's return. And that can cause all sorts of issues. Certain years, IRS is a little bit more picky. Some years we can really move it from one to the other with an explanation statement.
Mm-hmm.
I have seen randomly people get picked about that and then they chase them forever. Sometimes we can go for years and that has never get picked up. So I think the key here is to structure yourself properly to begin with to avoid any potential of IRS even asking any questions when it comes to this. And we want to make sure that your income is properly reported under your entity's name. And this brings me to this particular slide, which is really what is the benefit then of having this entity? So we form the entity, we now have our PLLC. Now what? So the S corporation election is something that is optional. It's not something you have to do immediately after you form the entity. However, this is where the tax benefits come in. So just as a brief overview, what is an S corporation? The S corporation is really how 99% of the small businesses that are active businesses in US are structured. And what it is, it's still you being self-employed in that you're the one really generating the revenue and incurring the expenses. However, when you're operating it as an S corporation, the income that your S corporation earns is not considered income subject to payroll tax. So let me back up here. When you're working for yourself, so if you're self-employed or you're a W-2 employee for another company, all of your earnings under those scenarios are subject to Social Security and Medicare tax. If you're working for somebody, you're only responsible for your portion of Social Security and Medicare, and your employer is paying their portion. When you're self-employed, you become your own employer and your own employee. Now you're paying 7.65% of Social Security and Medicare on one end, and 7.65 on the other end as the employer. Combined, your self-employment taxes are in excess of 15%. It's 15.3%. So that's a pretty big number. So when it comes to an S corporation, the income that is coming through to you as a net income after all the expenses are paid is actually considered just a pass-through income that your corporation makes. It is not considered income earned in self-employment. And as a result, that net income is not subject to that 15.3% payroll tax. It is a huge deal. The 15% can climb up there pretty quick. So how do we properly take advantage of this? Now, IRS says, this is fantastic that we've got this corporate structure, which is still passing the income through to the owner, but in substance, you, the owner, are still the one generating that revenue, incurring these expenses, because just a day ago, before you formed this PLLC, you were just a self-employed individual. So what has to happen here? IRS requires that if you move into the tax structure of an S corporation, that you pay yourself, or better said, your S corporation pays you, the owner, as an employee, a reasonable compensation for the services of running this business. Now, what is reasonable compensation? There's no magic formula. There's no right or wrong. The area is very gray. There's a couple of different ways that IRS uses to take a look at it, and we do as well when we help you establish what exactly is that compensation. On one hand, what's reasonable is, let's say if you hired somebody to run the company and manage your company for you, what would you pay them? If you were hired by somebody else to perform these duties and run a company, what would you get paid?
Mhm.
We also look at compensation as a percentage of revenue. So very typical in a service industry, in your guys' industry, in our industry as well. When you bring in $1 of revenue, you spend that dollar in three ways. You spend a third of that dollar to pay your people. You spend a third of that dollar to pay your expenses. And a third of that dollar you keep as a profit to you, the owner. So we often use a third split to determine the reasonable compensation. If it's just you and you're the only person in your organization, then we say, hey, if you bring in a certain amount of commission, let's say you bring in 100,000, we would like to see your compensation somewhere between 25 and 30%. The rest of it, you're going to have expenses, and then whatever is net income is your net income. Now, the compensation that you're paying yourself, again, it's just the IRS's requirement, because they're going to take that and tax it for payroll tax purposes. The rest of that net income that we just realized after paying the salary and paying the expenses is subject only to the income tax to you as the owner. The reason why that net income is not subject to payroll tax is that is the money you essentially collect for the risk that you took of running this business. So it's the risk and reward relationship. It's like you own stock and then you receive dividends. You actually didn't really have to do anything. You got the dividends. It is just rewarding you for the risk of ownership. That's why that net income is not really considered earned for purposes of compensation. But your salary, that's where you really earn the money. That's the part that you're compensating yourself for, running around and doing the showings and negotiating the contracts and all that good stuff. So remember, the salary is going to be subject to net income tax and the payroll tax, like putting you on the same footing as if you were an employee somewhere else. And then that net income that's passing through from the S corporation is subject to income tax only. So essentially, by doing the S corporation election, you have just protected that net income from 15.3% tax, all just by switching the tax structure. You haven't done anything different. You're still operating the way you're operating, but the 15.3% of that net income is a huge number. So the reason why I said that making an S election is not something that you necessarily need to do immediately after forming the PLLC. We always look at really how much income are you generating. So let's say if you're starting out and you only have a couple of closings, your commission may only be under $50,000 in year one. Well, after you've paid the expenses out of that $50,000 and you've got your education and you've got your marketing and initial setup, you're down to maybe 30 grand on the net income. It is not worth having to file a separate S corporation tax return, get yourself set up on payroll, and really deal with moving the money from, is this my salary or is this my distributions or draws and all that stuff. So it's just a little bit more costly because you've got these different pieces that you need to keep an eye on and pay for during the year. So then we say, just you're down to say 30,000 in my example, pay your income tax, pay your self-employment taxes, move on. Once you're hitting about 50,000 in net income, so this is your net income after you've paid your business expenses, we see that it becomes worth it to really do an S corporation election on your PLLC. And then you're now into the world where we do need to file a separate S corporation tax filing. Then we need to set you up on payroll. and determine what that reasonable payroll is. Make sure that the payroll reporting is done quarterly and you get your W-2 issued at the end of the year. And we got to keep an eye on that number because we're going to look at your commission. And then at the end of the year, prepare both tax returns. So all of these kind of different pieces are really going to be worth more once you are about $50,000 or more in net income. I also want to mention that the S corporation, the key there, and I've said this now several times, is that that net income from the S corporation is subject to net income tax. The key with the S corporation is the taxation of it is on a pass-through basis. And what does that mean? It doesn't matter if you took the money from the business bank account before the end of the year, you put the money back, or you said, hey, I don't want to pay tax on 20 grand, I'm going to leave it in the bank account. That's not how it works. Whatever your S corporation earned at the end of the year in net income, that's what you're getting taxed on. It doesn't matter where the cash ends up sitting. And if you're not paying yourself draws or not taking enough, it is the net income. What is the benefit of that? Once that net income is taxed in your hands, it will never be taxed again. So you can now take, if you've got net income of 100,000, even if you left 20 grand in a bank account and you only took 80, you're paying tax on 100,000. That means the whole 100,000 ultimately is yours to take. Once those earnings are taxed, it doesn't matter what year you actually take your draws, you have already paid tax on it. And that's the key here, is that the timing sometimes may not work to your advantage, but just keep in mind, you're only paying tax on that net income once, and that means your net income is yours to take. This is much like when you're self-employed. You're paying tax on your net income. You are enjoying all of the earnings after you've paid the expenses. And now, again, that is your money to keep. Same thing goes for the S corporation. So that is the benefit of the S corp, the 15.3% savings. But again, like I said, there's a couple of different moving pieces we need to keep an eye on, including the salary and the distribution. I think that those are kind of the important things. When you come to us for tax, we do go over these items with you. A lot of times it's just a matter of wrapping your head around it a little bit to understand the whole idea of that. Pass-through taxation of the company. So all of the same strategies on minimizing your income are going to be just as important in the S corporation as they have been for you as a self-employed individual. So we're still going to look at maximizing your expenses, maximizing retirement contributions. We're still gonna, look at all of those things. The other thing that I wanted to mention here, we have on our slide, is reducing the risk of the IRS audit. Just traditionally, anytime you put expenses on the S corporation tax return, it's a lot less likely to get looked at by IRS. IRS they love to pick on self-employed individuals. So if you've been filing your regular tax return, your 1040 schedule with a Schedule C, which is how the self-employed individuals file, any expenses on those Schedule C are very closely scrutinized by IRS because traditionally the self-employed individuals put their cats and dogs and neighbors as deductions on their profit and loss schedule. So the same deductions just look a lot better and subject to a lot less scrutiny on the business tax return. And that's just traditionally been the case. That's not to say you're not going to get audited, pulled for something or just randomly, but it definitely does reduce the risk of that maybe I did not mention as kind of the overall benefits of the S corp.
Definitely, it's really as simple as putting the same information on a separate form is literally lowering your risk of audit. It seems crazy, but that's absolutely true. And speaking of audit, I like to touch on a few of the hot button categories for the realtors. And I get a lot of pushback when I speak, when I try to bring up mileage. People don't like to track that, and they tell me how inconvenient it is. But I always rebut with, now there's apps and you have your phone everywhere because it's your super key. So now you can use MileIQ or any of the mileage tracker apps. They give a lovely report to us at the end of the year so you can prepare your tax return. And they also track all of your trips. So as frequently happens in this line of work, you're headed out to go to yoga and you get a sign call. So now you've got to turn around and go show a property. If you were logging your mileage in a journal, you would not likely have put that in, but it will capture it as a business trip so that you can deduct that on your tax. They don't have to accept. You're required to keep a contemporaneous record of your expenses, and they don't have to accept that as part of the substantiation for those expenses. They can just put you down to zero if that's your method. They're allowed to accept it if they want, but it's such an easy thing, and the app is really inexpensive and easy to use. And you can save specific locations, like if you want to save the RASM office or you want to save your closing agent's office, you can put that in there so it knows if you go there it was business no matter what. And then it will ask you the other remaining trips. It's kind of like a dating app, swipe left for personal and right for business, so that it knows what you did. And you can put a log in there. If you went to dinner, you can say, I took the Smiths to dinner after, showing property or whatever. You can put all the stuff that the IRS would want to know on those receipts anyways. Speaking of dinner, meals are still deductible, but entertainment went by the wayside. So no tickets to, sporting events and things like that now, unless you buy a subscription. And advertising is a big category that turns into a kind of a catch-all. And people want to throw everything in there. If you do that, now your advertising cost as a percentage of your total revenue gets really high, and that can increase your likelihood of audit. So I'm always a big fan of having a lot more detail. Use the other line on the tax return, whether you're on Schedule C or on the S Corp return, and break down the detail. Also will help you make better business decisions, because you'll be able to see, what did you spend on open house expense? What did you spend on Zillow? What did you spend, in a menagerie of maybe sponsorships or whatever. So if you've got that broken down, you're consistently applying it to the same category year over year. Your advertising category isn't getting too big, and you can make some decisions like, wow, I spent that much on this. Did that really benefit me? Is that a good use of the funds? And should I do that again in the future?
Let me also jump into the meals, because we often talk about meals and people get hung up on it and say exactly how much I can deduct and everything. There's really no limit on what's the maximum. Meals is going to be a fairly large expense for you, but it shouldn't be the biggest expense that you have out of all your expenses. So please be mindful. What we do like with meals is that you keep the receipt, and on the receipt you make a note as to what meal it was. So let's say, like Joanne said, you showed Smith's the house and you took them out for dinner. Please make a note on that receipt that you had dinner with Smiths who were potential buyers. Keeping the receipts is not really something that you need to do in just in paper receipt. Those receipts fade and disappear. So the smart thing to do, and I see a lot of my realtor clients are using some form of these things or another, is to scan it and keep a copy in PDF. I know there's different softwares out there. Like I'm working on one of the tax returns now, and they're using a tax bot where you can times the meals. We get a question, let's say it's a husband and wife and they're a team, and then they go out together and they say, well, we talk about business all the time, so can all of our meals be business expenses? Well, again, be reasonable. Business related. If if we feel that the meals expense gets a little too high, then if we feel that the meal expense gets a little too high, then maybe we will knock out some of that half personal, half business expenses. So just be mindful of exactly what meals were family meals versus what meals were really business meals.
Mm-hmm.
I also wanted to touch on the entertainment. Like Joanne said, entertainment is not deductible anymore. But if you do have a sponsorship, and let's say you sponsor an organization, and part of that sponsorship, you get a block of tickets, and then you can hand out those tickets to your customers or prospects, and then they can go and see an event. That is okay because that's part of your sponsorship package, so you can deduct it that way. I think that's kind of what I wanted to mention there on the meals. Anything else, Joanne, that you've seen when it comes to meals? Has that ever really been a big audit item on its own? I find that it's typically part of a kind of a bigger picture. It's almost like, well, what else is the problem there?
It is, and really what they use it for is to test the accuracy of your record keeping. So what they will sometimes do is they will say, particularly for the Schedule C people, it's easier for them to open your entire tax return when they're on Schedule C than it is if they're auditing an S Corp return. So what they can do is say, okay, all these meals, they're a lot with your husband and none are with clients. So let me see your personal bank statement and prove, like, let's see if you went to dinner 100 times, did you put 100 as business or 80 or 50? And they can look at your personal account to see that. And if you have no meals personally and all of them are in the business, they're definitely gonna say that's, you do eat personally sometimes. As much as it's easy to say that we work 24/7 now, that's not gonna fly. So that's another reason that I pump on Mile IQ. There's gonna be many things in an audit where you don't have enough documentation or you don't have exactly what they want. And if you've built up some credibility by having good records in other areas where it's really easy, it's kind of like good handwriting on a paper in school. They say, oh, well, we'll give you the benefit of the doubt because I can actually read it. So it goes a long way to building rapport with the examiner if you've got stuff like that in a good way, if good organization to it. The other thing I'll say is another thing I see realtors do that gets them in trouble into audits is you want to rely on credit card statements. And the IRS doesn't have to accept a credit card statement, particularly for things like meals and travel. So if you've booked a plane ticket for a conference, I would ideally want to have the flyer for the registration for the conference, which is going to show the location, the dates, the cost, a registration fee coming out of your business account for that conference, and then not just a charge for United Airlines, but a printout of the confirmation so they can see who the passengers are, what the destination is, and what the time is. Are you going to Vegas at a different time and just writing off the more expensive trip, or is it really line up with the dates that you've provided for the conference? Not to mention, if the conference is 2 days and you're in Vegas for a week, now hotel and meals and all that needs to be prorated for the amount of time that you were there for business. The business thing is the business travel, obviously now with COVID, is completely irrelevant. But in days gone by, I used to get a lot of questions when I was speaking where people would say, well, can I just make an appointment, one at the beginning and one at the end of the trip? I'll go to a real estate office on day 1 and on day 7, and I'll write off everything in the middle because I heard that at another seminar. It's kind of like when kids lie to you and you want to laugh because it's so ridiculous. When people say things like that doesn't even pass the laugh test. You cannot go somewhere on the first and last day and deduct the whole entire trip as business because of some bookending strategy. So keep that in mind. Like Marina said, reasonableness is always going to be the governing factor if you aren't certain what the rule is.
Yeah, in fact, if you go to the next slide, Joanne, that's exactly what we're talking about. And this works for any type of business organization. This is for any of your business, guys. If you've got a rental property, for example, and you're running that as a business, your real estate business, your spouse has a completely different business. In general, to test the business expenses, the expenses have to be ordinary for the business that you're running. So you've got to be in the business of doing it. Like I said, if we see the meals as the biggest business expense for you, you're not in the business of feeding people. So meals should not be the biggest expense that you have. So it's got to be an ordinary expense when you're incurring. It's got to be necessary for you to run your business. It's got to be directly related to the business. This is what Joanne was talking about, the travel. So how directly related was your trip? And it's got to be reasonable in amount.
Hey, Marina and Joanne.
These strict and examples, and this is why this is just audited to no end. So we definitely want to make sure that we are being reasonable in what we deduct, and deduct things that do make sense. And let me also tell you, if you've got a lot of expenses, you've got education, you've got a lot of marketing, you've got a lot of business travel and all your other stuff, if you're going to have a meal in there and a reasonable amount of meals, even if some of those meals were you and your spouse that are on a real estate team eating together, that's okay. We just don't want it consistently to be in there and really show up as, you know, the biggest expense in there. So these are really kind of the things you always have to get back to when you think about your expenses on any of the businesses that you own.
We've got in here a list of different types of deductions. We can email this to you if you like. Just shoot us an email. Keep in mind that these tax deduction rules are IRS rules. So FREC may have different rules. Your brokerage may have different rules, particularly when it comes to things like closing gifts. Keep in mind that whatever it is that you have put on any expense that you've spent on the business, some things are specific to real estate, like desk fees and Zillow fees and any of the lead generation memberships that are available. Those are specific to real estate, but the IRS has said that packages for like cell phone, for example, you might have your whole family on a cell phone plan and it's TV and it's home internet and it's the phone. You don't have to break that out for business usage. The IRS didn't want to spend time or money or assets allocating because it's such a small dollar amount relative to everything else to substantiate what portion is cell phone and what portion is business. Keep in mind things like open house provisions, like food and flowers and things like that. You're still going to buy that at Publix or Whole Foods or wherever you grocery shop. You're going to put that out. That's imperative that that's listed on that receipt to say this was open house provisions. You're going to buy things like fruit and cheese tray and things like, you're not going to buy a steak. And so they're going to look at that receipt to see, is this reasonable or is this your personal groceries that you're shoving into the business? Some things are very obvious and can be done on the credit card receipt, like recurring memberships. If you pay a set fee to Zillow every month, or you pay any subscription, your photography, and it's, 360 photography, that's very clear you're not doing that personally. So those kind of things are less important that you have the specific receipt. It's very important on the side of things like open house. We're going to deduct that and not be reimbursed by the seller. We need to have that receipt and state what it's for and why. Put the property address or the person's name that door handle is going to, because again, that kind of record keeping is what's going to be required at the audit and also build you more credibility with the examiner if you find yourself in an audit. There's nothing really fancy here that you wouldn't otherwise expect to see, but we're happy to email that list just because it's lengthy. I don't want to read every single line item to you. Now,
I did want to, can I jump in here with two notes on two different expenses? So the number one thing that I wanted to cover is home office. So that's always a good one. Can I deduct my home office? Because we all work at home all the time. So IRS is a little bit picky about the home office in that their rule is that you can only deduct rent or the use of space in one space that you work. So for example, I work at home all the time in tax season, on the weekends, at nights, you name it. I work at home, I work in my office. Since I'm already deducting my office space on my tax return, I am not allowed to deduct my home office on my tax return as well. So for the realtors, it will really depend on what the brokerage rules are. So in your brokerage, if you're already paying for the desk that you can actually go and do work and you're deducting that payment on your tax return, that becomes your rent space essentially. So then you're not really allowed to use the the home office. But a lot of brokerages do not have desk fees or really space that they're providing to the realtors to go and do the work, and they have to work at home. In that case, we do say that the home office is okay. Home office, there's two different ways to deduct it. You can use the safe harbor, which is $5 per square foot of the home office space, or you can prorate the square footage of the office space you use at home over the total square footage of your home and prorate general home office or general home expenses such as mortgage, interest, property tax, insurance, maintenance fees, you name it. We want to, again, be reasonable. The space that you do use at home cannot be your dining room, cannot be your kitchen. You've got to have dedicated space where there's nothing else that's done in that space other than the work. In the past, it used to be where it's also the space where you can technically meet with clients. For the most part, if you're working at home, you're probably a traveling salesman, and you're not really meeting with any clients in your home. But the space that you do have in your home office, it's got to be dedicated space that you're using for business paperwork only. You may have some storage. Let's say you've got some furniture that you're storing for showings or whatnot. You can also dedicate some storage space in your shed or your garage to it, but you can say, well, I work in my dining room and my dining room becomes my home office. Unless you never eat there ever again, it should not be your home office. So that's the home office. The other expense that I wanted to bring up is the car, and that is a big one. And what I really wanted to mention is we get asked all the time, what's better, mileage, lease, actual? Should I buy a car? Should I sell a car? Should I bike to work?
Don't get a car now, there's COVID. Get a bike.
Exactly. Just walk everywhere. It really depends. It depends on your particular situation. If you have been taking a mileage method, I love mileage because mileage gives you, it's a really high number. It's 58 cents a mile, and those numbers fluctuate every year depending on what IRS sets that amount to be. But that mileage rate, you don't have to think of keeping track of your gas receipts and all the other stuff. And at that high of a rate, you can really capture the use, the driving of the mileage. But sometimes leasing a car, if you've got a luxury vehicle that you're leasing, that may get you, in some cases, a little bit of a bigger deduction. Some of you like a big truck. If it's a heavy truck and you technically transport a lot of people, whatever the case may be, you can get that aggressive 100% depreciation that you hear about. And it just depends on what your situation is, your particular facts and circumstances are, and whatever works best for you. The overriding decision on the car should really be a cash decision. Can you afford? Sure, we can get you 100% deduction of your heavy truck, but do you need it? I mean, do you have 80 grand to spend on the truck all in 1 year and we can deduct it? Maybe, maybe not. Do you want to lease a Mercedes and pay $1,000 a month for a lease just so that you can get some tax benefit of it that's a little bit higher than the mileage? No. So make a smart decision for you, because even though I can get you a tax break is just a deduction. So say if you're in a 20% tax rate, any dollar that you spend only results in 20 cents of a benefit. Well, you still have to spend that dollar to get the 20 cents benefit. So think of it as the cash out of your pocket. And if you are not the guy to lease the car and you hate leases, well, don't lease the car for the tax deduction. So really make a decision that is smart cash flow wise. In one way or the other, we'll get you a tax break on your tax return. Don't worry if you're using your car for business. So on that, I'm going to leave it because I can talk about the car stuff for hours.
Well, and
please stop me.
I will stop you. I have to frequently get stopped at the home office. I'm like, if my husband had a girlfriend, I wouldn't hate her as much as I hate his home office. People spend so much time and energy gathering the information for the home office expense, and you get the average bedroom is on average 10 to 12% of the total square footage of the home. So you're getting 10% of your utility bills, which are already pretty low. Meanwhile, you're not an S corp, and you could save 15% of your total profit right out of the gate. Like, you'll sleep in the Best Buy parking lot for Black Friday to save 15% on a TV, but you won't pick a new tax form to save 15% on all of your income. I mean, it's like, it's fresh, it's mind-boggling. Oftentimes people aren't doing it because they don't know about it. But what kills me are the people that are in the class repeatedly. And I'm like, I know that you know about this. And it's so frustrating to see that number on the tax return, like you're overpaying by X and it's 2 numbers and a comma, like it's big double-digit $1,000s that you're overpaying tax, and all you have to do is change forms. It's insane. I'm saying all you have to do is change forms. There is a process. Of course, we can do it if you want to do it yourself. Do keep in mind, my disclaimer here is I will tell you exactly what to do, but I also will tell you that there's a lot of DIY on HGTV. There are no programs where you can watch people do their own legal stuff because it's not pretty. Nobody wants to see it. So what you can do is come here and watch what happens when we fix it. But if you're going to do this, you need to do all 10 steps. The problem is your PLLC or your PA, and you go to Sunbiz to do that. Frequently, that's where the music stops for folks. And they're like, well, I have this LLC. So there's a garage, there's nothing in it. The garage needs a tax ID number. You get that from the IRS. We need to file that S Corp election. As Marina said, there may be a difference in timing on when you do that. For most people, it's going to be right when they form. But for newer agents, they may say, I'm not ready to commit to a second tax return yet, but I want to have that liability protection in place. So that they issue you a new license that instead of saying Joanne Koontz says Joanne Koontz PLLC. The number doesn't change. It's like a lady getting married, just the name is changing. We then have to file a W-9 and turn that into the brokerage office so that your next commission check is issued to the PLLC and not to you. It is your duty to check on that and make sure that that's happened. Frequently, Marina has to disappoint people at the end of the year and say, well, you only got one 1099 and it's still in your name and social security number. How much success have you had getting them to fix that later, Marina? None?
Oh my God, and you know, some brokerages are really good and they will work with you to really fix it. But what happens is if you formed your PLLC in the middle of the year and you became an S Corp and you say, well, this is great, my whole year. Well, the issue is the broker is not allowed to report the commissions you've earned before you became a PLLC. If you were a PLLC January 1st and it was the broker's fault that in their system they didn't make a change, that's a different story. Then they can go back and fix the paperwork. And that's when I catch it at tax time and I say, I know you're a PLLC because we formed you and I see the formation documents January 1st, but your broker still reported to your personal name. But if you did not form that PLLC and the broker reported to you to your personal name, then we stick with that.
Yeah, definitely. If we do it, we make sure that first check is issued properly. We need to have a bank account for the PLLC. A lot of times what people say is, well, I already had a separate bank account that I was depositing my commission checks into and I was paying my expenses out of. That is not a business bank account. It is set up inside the bank institution as a personal account because you didn't have a business with an EIN. So I had to fight with people about this all the time because it's inconvenient and Amazon's already linked to it or whatever. But you really need to get a brand new account. For Morgan & Morgan purposes, if you're using a personal account, not a business account, they're going to say, see, there's no difference between just you and this business. And finally, people got to see the impact when PPP hit. When that program came and people were trying to make applications to their banks, particularly early on, the bank said, it's a personal account. This is an SBA program. You can't participate if you have a personal account. So it's very important. If you want to run this like a business and make money like a business, we've got to treat it like a business on the boring stuff too, because this Marina's favorite line, the devil's in the details. And that's exactly true. Again, no commingling. Pay all your real estate related expenses out of the business account, not out of your personal account. When people commingle, the number one reason they do it is because the other account is where the money is. If you haven't had a commission check yet, you can deposit personal money into the business bank account and then pay the business expenses. The flip side, you've gotten commission checks, now you need to pay your mortgage. Take a draw out of that business bank account, deposit it into the personal bank account, pay your mortgage out of your personal bank account. Those things are crucial when it comes to your liability protection. Same for tax. I mean, there's on an audit, if you've got a deposit into the business account, it's your job to prove it's not income. So we want to have the records there. Also, when you've got that draw money, if you've contributed money into the business, the first dollars back out are not going to have any tax effect because you're returning that capital. There you go. Make your transfers, then pay your expenses. Some kind of bookkeeping system is in order. This is often the biggest objection that I get when people say, I don't really want to get into fancy bookkeeping. Even on Schedule C, you need to be tracking your expenses. All we are changing is where you report the business income and expenses, the form that you use. You should still be tracking. And it doesn't have to be QuickBooks. It could be colored construction paper. As long as it's a system that you consistently use. A pile of receipts in a shoebox is not a bookkeeping system. You can dump them on some poor unsuspecting nerd on April 14th. You will not get a good product because that person is exhausted and mad that you sent them a shoebox. But more importantly, you can't make any business decisions throughout the year. Imagine the leaders at Google having no idea where the financials are. You can't run a proper business with a shoebox of expense receipts. You don't have any idea if what your strategies are working, if the money you're spending is effective. If using the bank account as your modality of determining whether or not you're profitable also doesn't work. Cash flow and profit are two different things. So it's imperative. It doesn't have to be a sophisticated bookkeeping system, but it needs to be something that you can use. And then of course, like Marina said, we've got to pay a salary. That IRS wants their little bit of payroll tax. But these 10 steps you can see are pay a reasonable salary is pretty far away from form it on Sunbiz, and you're not done when you get to Sunbiz. That's probably the biggest mistake I see people making. The most commonly missed issue is that people don't actually transfer their license with FREC, and then I go to look them up because they tell me how they have an LLC, and I see Joanne Koontz on the DeBeeper website, and if that's the case, your Ferrari is outside.
Mm-hmm. Yeah, and I catch that on the tax side all the time when I see those forms. Like I said, the form is under your personal name, mm-hmm. or the expenses, you bring me your personal credit card statement with the business expenses highlighted. I love that. I see those highlights and they're every fifth line. Oh, this was business, but we're not supposed to commingle. And right now you've just taken, again, all of the structure that you just paid to set up and even run the payroll, and you have no system for tracking your business expenses mm-hmm. separately. So all of those things are important. It is a business you're running, so please treat it seriously. Please, it's important, and we're here to help you with the infrastructure, with the tax savings, with the setting you up properly on the legal side, and just helping you succeed.
Absolutely. If you do have questions, I've put my email in the chat box. I'm happy to email anybody the list of the realtor deductions, the tax deductions. Just shoot me an email and we'll get that over to you. And if you need any help, let us know.
All right, thank you. Thank you so much. Does anybody have any questions that we can answer quickly? I have the chat box open. I got, go ahead and unmute yourself.
Okay. If there's no questions, we either did a hell of a job or everybody gave up and went home. Because it's a lot. I mean, it's a lot to wrap your head around for sure, but it's well worth it. You've got some legwork to get started. And then once you're up and running, it's pretty much same as you've been, and then you've just got your annual report filing. So it's really not, it sounds like a lot because we've shoved a ton of information into a small time, but I promise the day-to-day operations aren't terrible. I will say, if you are going to make the switch, you've also got to switch your marketing. So your business cards and signs need to reflect the PLLC because that is now the licensee. So you've got to change it in whatever you're using, Transaction Desk or Form Simplicity or .loop. When you sign a contract, you're now signing it as Joanne Koontz PLLC, a listing agreement, whatever. Joanne Koontz is no longer a realtor. It's now Joanne Koontz PLLC.
We have a lot of compliments in the chat box. Wonderful, says Heather George. Thank you. Susan Breckenridge, thanks. Great class.
Oh, thank you.
Great. Thank you, Ramon.
Thank you, guys.
Thanks.
Well, thank you, everybody. Have a great day. Stay safe and sell the hell out of everything you find.
Thanks, guys. Thanks for.
Bye.
Thank you. Mm-hmm. Bye-bye.